Hey everyone, welcome back to Corporate Decoder, the place where we unpack the confusing world of corporate filings and find the juicy details you need to know. You won't believe what two ETFs have been up to filling their shareholder reports. Get ready for a deep dive into how these funds performed and what it means for your money. We are looking at reports from Tidal Trust I for the period ending the 31st of July 2025. This covers two ETFs, the Aztlan Global Stock Selection DM SMID ETF and the Aztlan North America Nearshoring Stock Selection ETF. These reports give us a peek under the hood of their performance costs and what they invested in. First, let's talk about costs. For the Aztlan Global Stock Selection DM SMID ETF, if you had invested $10,000 over the past year, you would have paid about $85 in costs. That sounds pretty reasonable. For the Aztlan North American Nearshoring Stock Selection ETF, that investment of $10,000 cost about $75. Both seem to be keeping a lid on expenses, which is always good news for investors. Now for the performance, the Aztlan Global Stock Selection DM SMID ETF had an initial investment of $10,000 grow to over $13,900 by the end of the reporting period. That is a solid gain. Its benchmark and index, called the Selective Aztlan Global Developed Markets SMID Cap Index, did even better, reaching almost $14,900. The S&P 500 Total Return Index handsomely beat both at over $15,500. The MSCI World SMID Cap Index gross total return ended up around $13,200. So while the fund did well, it lagged behind some broader market indicators. Looking at annualized returns for the year ending the 31st of July 2025, the Aztlan Global Stock Selection ETF returned 26.03%. That sounds great on its own, but its benchmark, the Selective Index, returned 28.23%, and the S&P 500 did 16.33%. So for the year, it underperformed its own index, but still had a good return. Over its entire history since the 17th of August 2022, it returned 12.10%, which is respectable considering the market ups and downs. During the reporting period, the fund generated a total return of 26.03%. This compares to the 28.23% total return of the Selective Aztlan Global Developed Markets SMID Cap Index. The report says industrials and utilities were the leading contributors to performance, while materials and consumer discretionary were the biggest drags. Some of the top performers for the fund included Iveco Group NV Celestica Incorporated and Swissquote Group Holding SA. On the flip side, Abercrombie and Fitch Incorporated Methanex Corp and Alchemy Technology Inc. were the biggest disappointments. Stock picking clearly had an impact here. As of the 31st of July 2025, the Aztlan Global Stock Selection Fund was worth about $30.9 million. It held 52 different investments. The total advisory fee paid during this period was quite high at over $208,000. And get this, the portfolio turnover rate was a staggering 316%. That means they were actively trading a lot of the holdings, which can lead to higher costs and potential tax implications for investors. When we look at what the fund invested in by sector, industrials made up a decent chunk at 0.28%, and consumer cyclical was close behind at 0.219%. Financials were at 0.18% and consumer non-cyclical at 0.14%. Technology was 0.118%. Not a whole lot of diversification there in terms of sector percentage. The top 10 holdings were all around 2% each. Some names you might recognize include Screen Holdings Incorporated, Dormakaba Holding, AgCentrica PLC, and Sterling Infrastructure Incorporated. It looks like they have a pretty spread out approach to their top holdings, rather than putting all their eggs in one basket. Now let's switch gears to the Aztlan North America Nearshoring Stock Selection ETF. For this one, an initial investment of $10,000 grew to just over $10,700 by the 31st of July 2025. This is a much more modest return compared to the other fund. Its benchmark, the Aztlan North America Nearshoring Total Return Index, did a bit better, reaching about $10,900. But the S&P 500 Total Return Index absolutely crushed it, jumping to nearly $14,250. Clearly this fund had a tough year compared to the broader market. For the year ending the 31st of July 2025, this nearshoring ETF actually had a negative return of negative 3.61%. This is a big red flag. Its index also suffered a loss of negative 2.01%. However, the S&P 500 was up a strong 16.33%. Since its inception on the 29th of November 2023, it has returned 4.14%, which is not great, but it is something. The report states that this fund generated a total return of negative 3.61% for the period. Sector-wise, real estate was the biggest contributor positively, and industrials was the biggest detractor negatively. Some of the leading contributors included Fibra, MTI, SAPI DCV, and Air Transport Services Group Incorporated. Leading the pack of detractors, Universal Logistics Holdings Incorporated and TFI International Incorporated. This nearshoring fund is much smaller in scale than the global fund. Its fund size was about $10 million as of the 31st of July 2025. It held 31 investments. The advisory fee paid was $78,000. The portfolio turnover rate here was 184%, which is high, but not as extreme as the other fund. In terms of sector breakdown for this fund, financials was the largest segment at 50.8%. Industrials followed at a significant 42.8%. Consumer non-cyclical was much smaller at 5.1%, and consumer cyclical at just 0.01%. This is a very concentrated portfolio skewed heavily towards financials and industrials. The top 10 holdings are substantial portions of the portfolio. Matson Incorporated is 6.2% SBA Communications. Corporation is 5.6%. Expeditors International of Washington Incorporated is also 5.6%. Arcbest Corporation Hub Group Incorporated, Prologis Property Mexico, SADCV Kirby Corporation, Terreno Realty Corporation, Dream Industrial Real Estate Investment Trust, and Stag Industrial Incorporated all hold between 4.8 and 5.4%. That concentration definitely puts the fund at higher risk if any of these top holdings falter. Digging into the notes, we find some interesting details. The funds elected to be taxed as regulated investment companies, which is standard for ETFs. They aim to distribute most of their taxable income to shareholders to avoid taxes. Looking at the actual investments for the global fund as of the 31st of July 2025, we see a broad mix of common stocks across various sectors. For example, in apparel, they hold Crocs Incorporated. Under auto manufacturers, we see Iveco Group NV, and for auto parts and equipment, Toyo Tire Corp. Building materials include Buzzy S, Key A. Griffin Corporation, and Sanwa Holdings Corporation. Under chemicals, they list Methanex Corporation. Commercial services include Toast Incorporated, Trinit Group Incorporated, and Upbound Group Incorporated. It is important to note that some of these are non-income producing securities, which means they don't pay dividends. Also, some are Rule 144 as securities, which means they might not be as liquid. The statements of assets and liabilities give us a snapshot of the fund's financial health. The global fund had total assets of over $48 million and liabilities of over $17 million, resulting in net assets of about $30.9 million. The North America Nearshoring Fund had total assets of just over $10 million and liabilities of a mere $6,000, leading to net assets of about $10 million. The statements of operations show us how the funds made and spent money. For the global fund, investment income was over $691,000, and expenses were about $208,000, leading to a net investment income of over $400,000. They also had significant realized and unrealized gains from investments totaling over $6 million. The Nearshoring Fund had investment income of about $257,000 and expenses of just under $79,000. However, it shows a net realized and unrealized loss on investments of over $630,000 for the year. This explains why that fund S performance has been negative. The financial highlights per S-Hair give us a per S-Hair view of performance. For the global fund, the total return for the year was 26.03%. For the Nearshoring Fund, the total return was a negative 3.61%. When you see negative returns like that, it really highlights the risk involved with investing. Digging into the notes to the financial statements, we learn that Tidal Trust I is the umbrella entity for these ETFs. The investment advisor Tidal Investments LLC receives a unitary management fee, which means they pay all the operating expenses out of that fee. This structure is intended to simplify things for investors. Cohen Twin Company Ltd audited these financial statements. They confirmed that in their opinion, the financial statements present fairly the financial position of each fund. Under non-audited information, we find notes about qualified dividend income. For the global fund, about 66% of dividends were considered qualified dividends. For the Nearshoring Fund, it was 100%. This is good for investors as qualified dividends are taxed at lower rates. For corporate shareholders, the report also details the percentage of ordinary income distributions qualifying for the corporate dividends received deduction. The report includes a section detailing the renewal of the investment advisory contract. The board reviewed the nature, extent, and quality of services provided by the advisor, their investment performance, the cost of services, and economies of scale. For the global fund, the advisory fee of 0.75% was considered below the peer group average. However, for the nearshoring fund, the 0.75% advisory fee was above its peer group average. This is something to keep an eye on. The board ultimately approved the renewal, concluding the fees were fair and reasonable. So what is my take on all of this? The Aztlan Global Stock Selection DM SMID ETF delivered a solid return for the year, though it lagged its own index in the S&P 500. Its high portfolio turnover rate is a bit concerning as it can eat into returns. However, its size and diversified holdings provide some comfort. The Aztlan North American Nearshoring Stock Selection ETF, on the other hand, had a rough year with negative returns and highly concentrated holdings in financials and industrials. Its smaller size and larger sector bets make it a riskier proposition. Despite a strong marketing effort by the advisor, the performance here needs serious attention. That is our breakdown of these two Aztlan ETF reports. What do you think about their performance and strategies? Let me know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate deep dives. And for more exclusive content and to connect with fellow finance enthusiasts, jump into our Discord community linked in the description. Thanks for watching, and I'll see you in the next one.